Welcome back, YouTube. So today in the markets, but I'll say the markets got a bit of a scare because of the big three appeared to have taken some damage here, wrapping up last year, and it kind of sent I believe, a temporary shockwave through the markets here, just on a macro side. And it's one of the reasons why I believe that macros are so important to gauging the strength of the market here. And we saw a lot of catalysts coming out, and they're kind of backtracking now because of how quickly it kind of got like debunked as FUD. But we did see Apple, which pretty much had like a negative earnings report, which has not happened since 2016. But that was to be expected when we saw things like them rolling back production on the iPhone 14 and, just not having that same interest that we've seen with previous drops and stuff like that. But this has happened, and the reason I'm going with Apple first, because this is kind of the biggest shocker here, because Apple, I believe, was at like a $2 trillion valuation before the COVID and the hiccups and stuff that was happening in the market. But if we look at overall revenue, it's down 5.49% year over year. iPhone revenue down 8.17%, Mac revenue down 28.66%, iPad revenue is up 29.66%. Other products down 8.3%. Services revenue up 6.4%, and gross margin is 42.95 versus 42.96 versus 42.95. And let's not forget, and this is one of the things that I believe that was just especially on the shorter time frame, I believe that this was just an overreaction here. Apple has almost $40 billion in cash. They are absolutely fine. We haven't seen because I believe that we'll need more than a quarter to kind of gauge, okay, is the recession kind of taking place, or have we actually hit the bottom, and get confirmation on those numbers? And that's kind of what Powell was talking about the other day, was saying that we're going to need more data to gauge the strength of the tightening and and core inflation as well. Because quite naturally, you're going to look at these numbers and see some, which are lagging indicators. And we're going to have to look at this and see, okay, how much strength is this going to put into the market going forward to say, our consumers going to spend less when it comes down to technology and advertising, businesses advertising and stuff like that. We saw a decline from Google via YouTube ad revenue. So we'll see this kind of trickle over and say, okay, we need to have that pause to kind of see what the overall effect of the tightening is, and have we in fact over tightened. But I do believe now the market here, once we got the actual numbers and people looked through the spreadsheets and saw the available cash of these big threes, we saw pretty much a rebound for the most part in the market. Even in crypto as well, we saw, I'm going to switch over to my charts here, somewhat of a slight sell-off here in Dogecoin. Obviously, it gets hit the hardest, but it's pretty much recovering right now. We saw Bitcoin, I won't say it was unfazed, but it didn't have that drop down like we did earlier today. But we're still well over our 2271 mark at 23,543 right now. Ethereum is actually doing really well. I believe Ethereum got the break it wanted, 1644. Yeah, we had a high of like 1718 today, so we broke above the 1676 briefly, even the 1680 mark here. So Ethereum is certainly still doing extremely well here and threatening to have that breakthrough. And Cardano has been chugging along too. So at 40 cents, so about 4 cents below that pivot point there. So overall, I just believe it sent some shockwaves to the market, and some FUD got pushed out, and we saw some sell-offs. But overall, I believe that we're going to need more data before there is something like a panic there, because even yesterday when we looked at when I broke down Powell's speech, he was saying that even if they would rather continue and beat inflation in one go, and if they in fact over tighten, they have tools, quote unquote, to handle that, aka they'll turn the money printer back on and stimulate again to kind of give the economy that jolt it needs to not fall deeply into a recession. Now, not saying that it's impossible to have further restrictions here, again, because we are looking at lagging indicators, but overall, the earnings today, as far as for the companies and the shape that they're in, these are not alarming numbers. They have plenty of cash. These companies are not in threat of like losing their positions here. That's why I still refer to them as the big three. But they are nonetheless very important indicators for the overall tone of the market here. So, and for as far as for what we saw, as far as for inflation being high and people cutting back on spending and stuff like that, none of this should actually be a shock. I expect that to continue as long as we have these record high rates and stuff like that, and we're approaching the year over year for real estate, mortgage rates, all that kind of stuff like that. Even though we can see it kind of coming down, it's not coming down very fast. So, this can be a slower recovery here if we don't have like that V-shaped recovery. So I don't think that this is something to be like alarmed about. And I think that kind of dissolved itself in the market relatively quickly. And that's why we're seeing this stabilization very quickly after market closes. So we'll have an idea of the actual effect of this, but I don't believe that it'll cause a dramatic sell-off between now and like Monday. But overall, the biggest thing macro-wise is going to be that next meeting with Powell in March so that we can get their updated targets and to see if they're actually going to pause and if they're going to roll off that 5.25%. That is going to be the macro that's going to set the tone for the market for this year. So let me know what you guys think. Like, share, subscribe to the video if you found any value, and I'll see you in the next one.